The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome, everyone, to this week's episode of the Fed15 podcast presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that feds need to know in 15 minutes or less. So whether you are a seasoned federal employee or whether you are just starting out in your career, Fed15 has got you covered. So grab your coffee, grab your water, important to stay hydrated, and kick back and let us tell you what you need to know but might have missed in the federal space this week. We are your host. I'm Katelyn Murray, and I am joined by Mr. Dan Seif. Howdy, Dan.
How you doing, Katelyn?
I'm doing well. You know, we've had a little bit of a brief intermission in our spring weather. It was very warm and very nice, and the flowers are all budding and the trees are starting to bud out. And then today we've got a little bit of cold and gray and rainy.
Same here. And I think it's revenge of the groundhog because, as I mentioned last time, I did start ordering my mulch. And I got 5 good days of mulching in over that period. And I think the groundhog is trying to manifest in one direction. I'm trying to manifest the other. But they're much like Highlander, there can only be one.
He heard what you said about him last week on last week's episode.
Yes.
He heard we're moving in on his weather prediction territory.
Absolutely. He is not going down without a fight. Respect. But again, there can only be one.
That makes me think of Caddyshack. There's a whole groundhog narrative,
Boom.
A groundhog subplot to this podcast. Well, as fun as all of that is, we know that you came here to learn a bit about your federal benefits, and we have a bit to teach you. So we have a great article on my favorite topic, one of my favorite topics, HSAs, to go over this week. So I'll be talking a bit about that, and then Dan is going to talk with us. This is a really important article. I think, given especially everything that we've seen in the past year in the federal space, this piece is on how to navigate a claim escalation while staying solvent.
Yep. Absolutely.
So before we get into all of that, let's step briefly over into HSA corner. So HSAs were created. HSA, if you don't know, stands for Health Savings Account. These were created in 2003 under the Medicare Prescription Drug Improvement and Modernization Act. And what an HSA is, it's kind of, I call them like the unicorn of financial planning, because we have traditional IRAs or traditional TSP where we're putting the money in on a pre-tax basis. We are not paying taxes when we invest that money. The money grows tax deferred. And in retirement, we're pulling that money out and being taxed on every dollar at whatever our income tax rate is in retirement when that distribution is made. Then on the other side of the scale, you have Roth TSP or Roth IRAs, where you pay the taxes on the contribution before you make the contribution. You deposit it into the Roth TSP or Roth IRA account, and then it grows tax-free. And it is accessible, as long as you follow the rules, tax-free to you in retirement. So you're sort of choosing, when you're looking at traditional versus Roth, when you are sending that money through the income tax loop. With traditional, I am sending that money through the income tax loop right before I distributed it on the back end. With the Roth, I am sending that money through the income tax loop up front before I invest it, before it grows. And then it's accessible to me tax-free in the future. The cool thing about HSAs, because I'm sure you're thinking, Katelyn, why are you talking to me about TSP and IRA? I thought we were talking about the other part of the alphabet. The awesome thing about an HSA is if you use it correctly, you do not ever send that money or the growth on that money through the income tax loop. Let me repeat that because it is pivotal. If you use an HSA right, it is not taxable when you put the money in. It is not taxable as the money is growing. and it is not taxable when you pull the money out. People are always looking at how to avoid paying taxes, and this is how you do it legally. Okay, so let's talk about the eligibility requirements and how to level this correctly in your portfolio. In order to do an HSA, you have to be in an FEHB High-Deductible Healthcare Plan. There's lots of options. You have your choices there, okay? You also cannot be enrolled in Medicare or TRICARE, and you cannot be claimed as a dependent on another person's tax return. And this is a big one, but go with me, it's a decent trade-off. You cannot have, I get this question all the time, you cannot have a general purpose FSA, a flexible spending account, and a healthcare savings account at the same time. You cannot do both. You cannot have an FSA and an HSA. What you can have, two options. You can have a limited purpose FSA for dental and vision. That's allowed with an HSA. You can also have a dependent care FSA. That's allowed with an HSA. Okay. Funding here, the FEHB is going to contribute a portion of your high deductible healthcare premium to the HSA monthly. Employees can also contribute additional funds up to the IRS limit. That limit for 2026 for an individual is $4,400 per year. And the family limit, if you have family coverage under FEHB, is $8,750 per year. That's as 2026. These numbers do index every year for inflation, most years. If you are over 55, hear me on this, over 55, not 50, like your TSP. If you're over 55, you can make a catch-up contribution of $1,000, and that starts the year you turn 55, even if you're turning 55 on December 31st of that year, okay? So why are HSAs so great? Well, like I mentioned up top, if we use this thing right, we never send it through the income tax loop. We make a pre-tax contribution, we get tax-free growth and interest, and we get tax-free withdrawals for qualified medical expenses. So there's the caveat, okay? This is why a lot of people call HSAs the healthcare IRA, because you have to use the money for qualified healthcare expenses. Now, what's qualified? There's a ton of stuff. You can go to hsastore.com and see all of the stuff that is already HSA approved. For example, I got a water filter, like one of those Brita water filters, except it is like super intense and it filters out like everything it's supposed to help with cancer prevention. And that was HSA eligible. I had to submit a little form and get an approval, but that was HSA eligible. So lots of things are Band-Aids, sunscreen used to be. HSAstore.com is where you want to go for that. Or you can Google HSA qualified expenses. So what are the advantages here other than we don't have to send it through the income tax loop? Well, your funds are going to roll over annually. And what that means is that the money that you're not using in your HSA for healthcare expenses can be invested for long-term growth. It's not like the FSA where it zeroes out after a certain amount of time, okay? Contributions are allowed as long as you meet the requirements and you're in a high deductible healthcare plan and you're not signed up for TRICARE or Medicare. You don't have to take an RMD from an HSA. That's pretty powerful. If we think about how much money we can put in a traditional IRA or a Roth IRA, right? It's $8,600 a year if you're 50 or older. I can put $8,750 in my HSA right now, every single year. And 55 and up, I can put $9,750 in. Okay, so I can save more to this HSA than I can to an IRA, and I don't have to take RMDs on the amount. You're starting to see, hopefully, the benefits here of this type of an account. Yeah, absolutely. Medical expenses that you incur after you've opened the account can be reimbursed later. So as long as you keep the one rule is you got to reimburse in the year that you had the expense. So if you want to save your receipts all year, then at the end of the year, do one big reimbursement from your HSA, you can do that. Hear me out. If you're not already retired, I would recommend making room in your budget to pay for healthcare expenses out of pocket. Save the maximum to your HSA every year or as much as you can. Invest that money and let it grow. Treat this thing like a healthcare IRA, okay? Because for all the reasons we talked about, right? You can invest the money, you can grow it just like your investment portfolio, and over time, you will not have to face RMDs on those amounts. Now, a couple of downsides, okay? You do have to be in a high deductible healthcare plan, okay? That's going to carry in itself higher deductibles. It's in the name, right? and some additional out-of-pocket exposure. So people that an HSA may not be great for. If you go to the doctor a lot, if you have a lot of prescriptions, if you have a lot of healthcare costs and you need a non-high deductible health plan to help you with those costs from a cash flow perspective, that may not be the best option for you. If you have young kids and they're going to the doctor all the time and you can't bankroll that from cash flow, might be less of a good idea for you, right? But there's a ton of people who HSAs I think are great for. Couple considerations. You do have to stop your contributions once you are enrolled in Medicare. Excess contributions to the HSA is going to trigger a 6% tax penalty. That's not nice. So don't go over that limit. Most plans are pretty good about not allowing you to, right? But if you are in a situation where you've switched jobs and you've switched plans, you want to make sure that you're tracking all of that. And then lastly, you got to be good with your note taking. You got to keep your receipts to claim reimbursement there. The last little caveat that I'll add is in retirement, right? Your HSA can come with you into retirement. No issues there. You're going to want to start tapping that thing in retirement for your medical expenses, because when an HSA owner passes away, the downside of passing that HSA on to somebody else, if it's your spouse, it's totally fine. They can treat it like their HSA and we're good. But if you pass it to your child, all of it is cashed out and it is taxable immediately. So not a great legacy planning vehicle. So if you think about your number one expense in retirement, it is likely going to be healthcare, believe it or not. As fun as that is, as we get older, we have increased healthcare costs and things like that. But the cool thing about your HSA is once you turn 65, you can pull funds out from your healthcare savings account for any purpose without incurring any kind of early withdrawal penalty. So if you pull money out from your HSA before 65 to buy a car, for example, not only are you paying taxes on that money because you didn't use it for qualified healthcare expenses, you're also paying a 20% penalty. Yes, 20, sure. Not 10, 20. So it's very steep, right? But once you turn 65, you can pull money out of that HSA for anything. Doesn't have to be qualified healthcare expenses. And you don't have to worry about the 20% penalty. You'll just pay taxes. So if you end up retiring and you have a massive HSA and you're like, Katelyn, I'm just not going to spend all of this on healthcare. Spend what you can on healthcare. Definitely don't pull out of your other accounts for it. But then you can also look towards the HSA to supplement some of your income elsewhere, and it basically functions like a traditional IRA, which is no big deal because you didn't pay taxes when you put the money in anyway. So this is a really cool hybrid type of account that
Sure.
has a lot of financial planning applications. Highly, highly recommend looking into it. And the best time to do this is like when you're young, 20s, 30s. When you get into your 40s, you got kids, they're spending all kinds of your money on healthcare appointments. And then there's maybe a moment in your 50s when you can kind of go back and fund the HSA, but really, really highly recommend incorporating these very unique types of accounts into your planning strategy.
Agree. Super powerful. And Katelyn, I wouldn't worry too much about these massive balances that could happen because I have faith in the free enterprise system and we will see the rise of the healthcare cruise.
Yeah.
Yes.
Yeah. Yeah, I think it definitely,
Transatlantic crossing on the QE2 with doctors. You're ready to go.
Here's the thing. We always want to take this with a grain of salt, right? Would it suck to inherit an HSA and have it all cashed out and taxed? Yes. Would I be mad if somebody left me like a $500,000 HSA that I had to pay taxes on? No, because I'd have the money to pay the taxes and some left over. So, all things in context.
Absolutely. Okay. So, folks, one of the things we have been with you face to face throughout the last 14 months now. And we know so many people were asked to make life-changing decisions in 7 days or less. And now, the insult to injury, their retirement package is getting bogged down. So if you know my background, the hardest thing for me is to learn something and I can't do anything about it. So we tried to put our heads together to come up with a practical approach to this and to identify what is normal in the current situation and where you need to escalate. So typical process, HR completes the retirement package, then there's payroll center review, file is sent to OPM, the claim is logged, and interim pay begins. And then historically, before 2025, 6 to 8 months later would be the final adjudication, and that's when your final pension payment would begin. I'm not going to spend a lot of time on explaining the nuances of interim. We actually have podcasts, I believe, that cover that. We definitely have articles that do on the site. So, number one, accept the fact that agencies and payroll providers operate at different speeds. You may have different staffing within different agencies. It is not uniform. And a retirement surge will slow that timeline. Interim pay typically begins when OPM receives the complete file. Most delays occur during file intake or interim pay setup, not during the final review. So let's get to some practical things, how to track your claim and confirm where it's stuck. So start with HR and request certification date, date sent to payroll, and date payroll sent to OPM in that order. At this point, you should have an OPM claim number. If you don't, and all those other things happen, call OPM to confirm receipt and interim pay status. Typically, no claim number generally means the file might still be with HR and payroll. Okay, so now you're doing some productive sleuthing. Best practices. Maintain a call log, including date, contact name, ticket or reference number, and the next expected step. Organize your records to help confirm the OPM retirement pay status and reduce repeated explanations. So you have it bulleted out so you can fire it out. And then once that's shared, hopefully you don't have to share it over and over again. So if you need to escalate, what is a smart escalation sequence? Step one, contact agency HR or benefits office to confirm package completion and submission. Step two, contact payroll provider to confirm transmission to OPM. Step three, contact OPM Retirement Services to obtain your claim number and interim pay status. Now, if delays continue, so here we get to steps that you can take. First is to request supervisor escalation. Second, contact your agency's retiree liaison. Third, and this is the big hammer, don't go to it first, is reach out to your congressional constituent services office, because that's what they're there for. I have seen these resolve things. Now, what they cannot do, because again, we're in deep with you on this. So we've experienced this along with our clients and just the people that we've helped through our part one, part two process. If it's just because it's in the stack somewhere and they're working their way through the stack, your congressional person is not really going to be able to influence that much. But this is another place where having all your documentation in order will help your congressperson's office. Okay. A couple of things for which you need to prepare so that you have a cash flow bridge if you're in an extended period without something coming in. Prioritize the essential expenses, housing, utility, groceries. Hate to say it, but may need to stretch here where you reduce discretionary spending. Use auto pay for minimum bill payments to avoid any missed payments. Okay. Temporary solutions might include part-time work, tapping into your cash savings, small non-retirement withdrawals. I would urge you to use borrowing as a last and limited resort and keep it to low-cost short-term options. A couple of things and behaviors to avoid. Avoid panic selling of investments during the short-term income gaps. Absolutely avoid high-interest borrowing while waiting for the interim pay. Make sure, write this down, that you are paying your FEHB premiums to maintain coverage. Okay. And then once everything starts, review your tax withholdings once payments begin. So key things to do. stay organized. Get those SF50s, retirement applications, HR correspondence, payroll confirmations, beneficiary forms, and OPM letters. Keep that together and create a one-page timeline. So if you want to share this with your elected representative, contain HR submission dates, payroll transmission dates, OPM receipt confirmation, and most recent contact name and status update. Okay. I wish it were otherwise, but retirement processing delays are going to be part of our reality for a while here, because under normal circumstances, there's always a little bit of a backlog. And then when you have 378,000 people that are going out, many of them retiring, that's a huge additional impact. So they increase during retirement volume periods. Your regular follow-up can help keep those claims moving. Temporary spending adjustments. They're no fun. Nobody likes them. We like those about as much as we like the word diet, but they can help you bridge gaps. And again, interim pay will usually begin once OPM begins the intake process, even if the final calculations will take longer. So pack your patience, but have a rubric for how you're going to set this up and follow up. And the other thing, be nice. Okay, the people that you're talking to did not create the problem. And I live in the real world. I know from my own personal experience that nice people get a little extra effort out of life from other people. So that would be my final thought on that.
In other words, as my Southern grandmother would say, you catch more flies with honey than you do vinegar.
That's true.
Flies, bees, whatever kind of flying insect that you want to
Absolutely.
tag in there.
Or as I would like to say, to quote that great sage Dalton from Roadhouse, be nice.
Mm-hmm. There you go. Love it. I love a situation where we can quote my grandmother and Dalton at the same time. All right, folks. That's going to do it for us today. That's about all the time that we do have, but we'll be back around next week to bring you all the latest updates that you need to make informed decisions about your career and your financial well-being as a Fed. Retirement preparation does not start 6 months before you retire. It starts in the beginning.
Absolutely. And be sure to subscribe to this podcast. Hit that subscribe button on our YouTube channel and Spotify so you never miss an episode. And please remember to share it with your friends and colleagues.
Mm-hmm. And for more information on the topics covered in today's show and more, be sure to check out our blog at blog.stwserve.com. While you're there, you can subscribe to our newsletter, The Weekly Serving, to get all the latest news for Feds delivered straight to your inbox every single week.
And let's not forget our webinars, Katelyn. What do we have coming up?
So we have some really good sessions that are coming up here for you. Obviously, we're in tax time. We're in the thick of tax season. We do have a tax planning session coming up on April 1st. That'll be from 11 a.m. to 2 p.m. And Ed Zerndorfer will be presenting that session. And I am actually hosting that one. So come by, stop by, see me, drop in the Q&A that you came from Fed15, and I will be delighted to see you. We've got another session about a week later that's actually on TSP planning. So when I was talking about Roth versus traditional and all of that crazy kooky stuff with the HSA, if that was confusing you, or if you want to hear more about that, we will have a TSP planning session on April 7th. That'll be from 11 a.m. to 2 p.m. And Dan is presenting that session, and I'm also hosting there. So you can't escape me here in early April.
Absolutely. And if you're looking for a more personalized approach to your education, you do have the ability to set that up. Contact us. What's the best email for that one, Katelyn?
So we're going to want to use meetings@stwserve.com if you're looking for a personalized experience, if you're looking to kind of take the federal benefits education a little bit to a deeper level and specify it to your unique circumstance. We would have you send us a message there, and we'll be happy to talk with you.
We will happily take on the role of your trusted guide to take you up the mountain and bring you back down safely.
Mm-hmm.
So
absolutely.
That, I think, is all we have. So thank you for listening to Fed15. I'm Dan Sight.
And I'm Katelyn Murray.
And we will see you next week.